$106,000 for one single Bitcoin. That startling figure sent shockwaves through both dedicated crypto circles and casual onlookers alike. After all, who would have predicted such a spectacular rebound amidst violent upheaval overseas and wild speculation in traditional finance? Hold on tight, because in this video, we are tackling one of the most dramatic surges in Bitcoin's recent history, a sudden leap back to 6 digits that happened alongside mounting tensions in the Middle East, unexpected policy moves from the White House, and intense speculation about central bank interest rates. Yet there is far more simmering beneath the surface than just a price chart spectacle. Today, we will reveal the inner currents swirling around this digital asset phenomenon, from the stormy international conflict that threatened to unnerve global markets but instead triggered renewed appetite for decentralized assets, to the subtle signals from large-scale financial players that may be fueling a powerful new wave of demand. In this episode, we will delve deep into 3 crucial mysteries. First, why did Bitcoin suddenly tumble below $98,500 on Sunday, breaking a 45-day winning streak? And how did it so quickly reclaim the $106,000 level by Monday? Second, was the cause of that shocking drop an honest reaction to mounting threats in the Middle East? Or was it tied more closely to a seemingly minor 8% dip in the network's hash rate? And finally, what does the global appetite for risk or caution mean for Bitcoin's potential next target of $110,000? Buckle up, because we are peeling back every layer. Now, the journey starts with a dramatic turning point that nearly every headline has latched onto. The Sunday meltdown that saw Bitcoin dip below $98,500 for the first time in 45 days. Rival coins also wavered, but none overshadowed Bitcoin's enthralling narrative, an asset teetering on the edge of a potential meltdown, saved only by an extraordinary Monday revival. Some watchers pinned the blame on intensifying conflict in the Middle East. Serious rocket fire, harrowing rumors of escalation, and hints of a prolonged standoff were enough to rattle even the most experienced traders. It seemed the entire macroeconomic landscape was teetering as well, with crude oil futures spiking and big indexes such as the S&P 500 wobbling. But before many in the market could even take a breath, Bitcoin soared right back up, punching through $102,000, then $104,000, and seemingly unstoppable until crossing that pivotal $106,000 threshold. So, how can we explain such a wild rebound in such a short time frame? That question leads us to the curious role of international politics. United States President Donald Trump dropped a bombshell announcement about a total ceasefire between Israel and Iran, describing it in almost triumphant terms. Observers, especially in the crypto space, reacted with a hesitant optimism, eyes wide open to the possibility that tensions might de-escalate as quickly as they had arisen. The immediate effect was a wave of relief across certain asset classes, including this poster child of digital autonomy, Bitcoin. Yet if you think this story ends with a neat resolution, you would be mistaken. Beneath the celebration of Bitcoin's surge lurks a deeper fear. What if the conflict revives, or even escalates, in unexpected ways? After all, Middle East tensions never truly vanish overnight. Some traders suspect an ongoing, deeper volatility might set in, creating fertile ground for safe haven assets. Gold, for instance, often captures the spotlight in uncertain times, but Bitcoin has claimed an increasingly prominent role as a sort of digital equivalent. It's that relationship between fear in traditional markets and optimism in crypto that may well define our conversation today. In this episode, we dive into the big question. Do the institutional titans that have embraced Bitcoin for its promise of absolute scarcity and independence from government meddling now see it as a hedge against geopolitical risk? Or does talk of Middle East tensions overshadow the fundamental reasons for Bitcoin's unstoppable momentum, such as the upcoming halving cycles, improved mining technology, and robust derivatives markets? For many watchers, Bitcoin's ability to snap back above $106,000 is nothing less than a bold statement from institutional investors. We are here to stay. But let's not gloss over the other half of the story, the vantage point of Bitcoin miners who secure the entire network. The raw data reveals a striking piece of the puzzle. Between Sunday and Thursday, the network's hash rate plummeted by around 8%, dipping from 943.6 million terahashes per second down to roughly 865.1 million terahashes per second. On paper, That's a big drop, and some speculators have connected it to possible mining outages in regions affected by Middle East turmoil. Now, to be fair, we have heard for years that certain states within the Middle East, especially Iran, might be hosting major underground Bitcoin mining operations. Some estimates suggest as much as 2 gigawatts of power usage feeding clandestine rigs, a phenomenon that is difficult to pin down or confirm. The truth is that real data from these areas is notoriously scarce. Daily power loads, equipment shipments, and operational overhead remain behind a thick veil of secrecy. Whenever a big conflict roils the region, rumor mills churn. Are those miners forced to shut down? Are they relocating their rigs? Could that cause an abrupt dent in the global network's hashing power? We cannot say for sure, but longtime miners and analysts in the field repeatedly remind us that fluctuations in hash rate happen all the time. One day, it might be an unexpected spike in electricity demand in Texas. Another day, severe storms might wreak havoc in Oklahoma, leading to power cuts. We saw it happen in April, when storms and at least 17 confirmed tornadoes lashed parts of the United States, slashing the Bitcoin network's hash rate by a stunning 27% in a matter of hours. That event, more than conflict in the Middle East, proved to be the prime example of how nature itself can disrupt these massive mining farms. So, while an 8% hash rate drop is nothing to scoff at, it also isn't a historically unprecedented crisis. Does that mean we can coast along and ignore the impact of geopolitical tensions? Absolutely not. And that's where we have to raise our next question. Could the region's ongoing instability put long-term downward pressure on Bitcoin as spooked investors flee from riskier assets? Or might it just as easily fuel further interest in a borderless monetary network, especially if local currencies and economies are thrown into disarray? If you are intrigued by these conflicting possibilities, show some love and give this piece a quick like. It is always exciting to see how these global narratives can reshape the entire crypto landscape, and your input helps us understand what resonates with you. Now, let's expand our lens beyond the hash rate drama to the wide realm of derivatives, a corner of the market that some call the real barometer of institutional sentiment. A glance at the numbers from the latest meltdown and rebound reveals that traders saw roughly $193 million, yes, spelled out, that is 193 million, in liquidation of bullish Bitcoin derivatives positions. That equals about 0.3% of the total open interest, which stands near $68 billion. Here is what's astonishing. Within 48 hours after that liquidation wave, the open interest figure basically returned to its previous level, hinting that the appetite for leverage remains robust. In other words, major players on the futures and options side of crypto are not flinching. They may have been caught off guard, but they are still in the fight, stacking up new positions as if the weekend's upheaval were just a bruising wake-up call rather than a crippling blow. It conjures up the image of an ultra-resilient fighter who, after suffering a knockdown, leaps right back up, thoroughly sanguine about the next round. Could it be that these traders see $110,000 in Bitcoin's near future? That possibility forms a swirl of debate around the digital asset's short-term horizon. Complicating everything is the matter of monetary policy. Less than 1 year ago, the United States Federal Reserve embarked on a path of tightening rates, jacking them up to 4.25% in an effort to tame inflation. Yet, markets are notoriously forward-looking. Now we hear rumors of potential rate cuts, with the probability that the Fed will maintain its current rate through November, tumbling to single digits. It's a jarring turnaround, and it raises eyebrows across the entire financial ecosystem. After all, the easy money environment of recent years occasionally triggered big runs in speculative assets, including Bitcoin. Could the same dynamic be playing out again? Specifically, there's talk that if the tensions remain subdued, the Fed might feel it has enough breathing room to cut rates more aggressively, which could feed a fresh wave of liquidity into equities and alternative assets alike. Meanwhile, oil prices have whipsawed, peaking around $77 per barrel on Sunday before falling again. The stock market took that as a welcome sign, with the S&P 500 index climbing by about 1% on Monday. Any further stabilizing of the Middle East situation could continue to weigh on oil, which ironically might fortify investor optimism and spur them to embrace more risk, including the likes of Bitcoin. At this point, let's pause and reflect. If you have been glued to these developments so far, and you appreciate dissecting every nuance that shapes the future of digital finance, why not subscribe for more? We bring you the big picture as well as the hidden details, ensuring you always have the potential to stay a step ahead in this ever-changing crypto saga. Still, it would be naive to say the path is crystal clear. A half-dozen hazards loom on the horizon. One is the possibility that the ceasefire might be short-lived, flaring back into direct conflict that shakes investor confidence all over again. Another is the persistent fragility of global supply chains and inflation patterns. What if unexpected data spooks the Fed into halting any plans for rate cuts, or even pushing them further out? In both scenarios, Bitcoin could face new tests of its resilience. Let's not forget that while a 4.4% intraday drop may not be historically huge for a currency as volatile as Bitcoin, it's still large enough to keep traders on edge. At the same time, certain observers emphasize that we have seen 3 similar drawdowns in the last 30 days alone. Bitcoin's wild mood swings are part of the experience, so perhaps the real story is its ongoing upward momentum. Every time the market stumbles, it bounces back harder. For example, the powerful push to $106,000, after briefly flirting with a disastrous dip under $98,500, is reminiscent of how unstoppable this asset can feel when the fundamentals align. On the subject of fundamentals, no discussion would be complete without talking about the upcoming Bitcoin halving, scheduled to happen soon, fueling excitement and speculation that the limited supply dynamic could turbocharge the price once again. Large institutions, from asset management behemoths to pension funds, are increasingly dabbling in crypto. They see a transparent, mathematically defined rarity that can potentially serve as a hedge in times of government-created inflation. Add to that the narrative of potential crisis in the Middle East, and you have a climate in which traditional safe havens such as gold might face a surprising challenger. So, is the major conflict at the heart of this story truly encouraging massive capital flow into the Bitcoin ecosystem, or is that a bit of hyperbole? Some experts remain cautious, pointing out that direct links between a Middle East ceasefire and a rally in Bitcoin are not so easy to prove. Correlation does not always imply causation, after all. They argue that we could be witnessing internal market forces dominating the stage, whale movements, derivatives roiling the order books, or even short squeezes that generate big buy volume in a compressed time. But plenty of people prefer a simpler explanation. In times of fear, investments that stand outside conventional banking systems become more attractive. If regulatory bodies or local authorities freeze assets, or if conflict threatens national treasuries, having a decentralized store of value can be extremely appealing. Let's not forget that story of how Bitcoin soared during various crises in the past. There's a reason that the concept of a safe haven digital currency has lingered in crypto lore for so long. Moreover, the precipitous drop in hash rate stokes big questions about where mining actually happens and which factors can derail it. If indeed tens of thousands of mining rigs operate in secrecy, especially in hotspots like Iran, then any major political plot twist might suddenly hamper the ability of those operations to run smoothly, or it might push them underground even further. Meanwhile, as we have heard from analysts like Daniel Batten, big changes in the hash rate often link more directly to sudden weather calamities in states like Texas, where frantic storms can drive players offline, than to slow-building geopolitical developments. So, what about the path to $110,000, the next milestone that many bulls have pinned their hopes on? The upward momentum suggests it's within striking distance, but caution reigns. Even the most ardent Bitcoin proponent admits that ongoing conflict, spiking fear indexes, or a sudden shift in Federal Reserve policy might deliver another short-term shock. Then again, if the ceasefire truly holds, if oil prices keep drifting downward, and if the Fed signals a readiness to cut rates, why not expect another big move up? For most people, the real question is, do we interpret Bitcoin's bounce above $106,000 as a short-lived anomaly, or do we see it as a bold statement that huge players are unshaken by global turmoil? Even though nobody can predict the future with absolute certainty, the immediate data speaks volumes. The derivatives market stands firm, open interest is barely dented despite liquidations, and a wave of believers continue to buy the dip. That leads us to one more intriguing angle. How does the broader risk environment look for investors who are used to juggling a range of assets? Stocks, bonds, commodities, and now cryptocurrencies? If the story in the Middle East worsens, Pushing oil back up, we might see a flight to more conservative assets. Equities could falter, and even Bitcoin might see some panic-driven selling, at least in the near term. But if the Middle East tensions truly cool off and the ceasefire holds, investors might feel bolder, especially if the Fed leans dovish and signals rate cuts. Then, Bitcoin's next push could be truly spectacular. Like so much else, it all boils down to a tug-of-war between fear and greed. Fear is the tension in the Middle East, the caution about whether the Fed's policies will shift unpredictably, and the constant question of whether a 4.25% benchmark rate still offers alternative havens. Greed is the robust appetite to pounce on a rapidly climbing asset in hopes of capturing mind-boggling gains before the rest of the market decides to chase those elusive new highs. Keeping all these factors in focus might feel dizzying, but if there's one thing we've learned from the mania of the pandemic bull run to the anxiety-laced dips that followed, it's that Bitcoin thrives on volatility. Moments of chaos can translate into powerful growth spurts, especially when macro conditions align. The stories of institutional accumulation only underscore that conviction. Big money is not spooked by the occasional drop. They see the bigger picture, a digital asset that might one day be as mainstream as any major commodity or stock index. Of course, the first step to harnessing that potential is understanding the full arc of these developments. We need to follow how the Middle East conflict evolves, watch every twist and turn in the Fed's rate narrative, and track the movements of the derivatives and mining communities. By connecting these dots, we get hours of drama, reflection, and ultimately, a deeper idea of how Bitcoin's story might unfold in the months and years to come. On that note, I hope this journey has been as fascinating for you as it has been for me. The interplay between global headlines and the cryptoverse never ceases to amaze, whether we're talking about spontaneous hash rate drops, curious price rebounds, or hush-hush mining operations that may or may not flourish in the hot desert sun. Watching all these threads weave together is exactly what makes the Bitcoin narrative so thrilling. So, let us keep the conversation alive and the curiosity burning. Thank you for staying until the end of this wide-ranging exploration. Whether you are a steadfast crypto bull, a skeptical investor, or somewhere in between, these paradigm-shifting events remind us that the world of digital assets remains as dynamic, and sometimes unpredictable, as ever. We might be just one ceasefire announcement away from the next explosive rally, or a few escalations away from a new wave of panic selling. But one thing is certain, Bitcoin has once again proven its knack for resilience, bouncing back when critics expect it to unravel. Perhaps that alone explains why so many eyes remain on this sphere. By now, the lines separating international diplomacy, energy grids, and decentralized ledger technology are thoroughly blurred, making for a captivating, ever-evolving narrative that you will not want to miss. So stay tuned, because if recent events are any indication, tomorrow might bring yet another headline filled with intrigue and adrenaline, and we will be here to turn that chaos into clarity.